Hello everyone, welcome to my channel. In this video, we're going to talk about Lucid Motors, trading under the ticker symbol LCID. Before today's video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. In recent days, the share price of Lucid has been hovering around the $4.20 to $4.50 level, experiencing around 3% decline over the past 5 days and a similar decrease over the past month. Over the past 6 months, the share price witnessed a substantial drop of around 40%, reaching its lowest point on November 9th at $3.78. Lucid gathered a lot of attention as the underdog, often dubbed as a small Tesla, with a significant market cap potential. Many investors were eager to get in early and to ride the wave of growth all the way to where Tesla reached at some point, especially given Lucid's US-based operations, which shielded it from import tariffs affecting other players like NIO. Back in 2020, Lucid was viewed as a promising player in the EV sector, with its stock reaching a record of $55 during the peak times. However, the current landscape is far from those glory days. Lucid is no longer seen merely as a cool EV maker, and the overall perspective for the EV sector has also evolved, impacting Lucid's overall standing. Examining the financials has told us that Lucid's revenue didn't experience a significant surge in the past few quarters, and the persistent supply chain challenges in the EV industry remains. Considering the circumstances, a cautious approach to Lucid in the upcoming year is advisable. The financial indicators do raise concerns, and given the potential economic challenges, it's prudent to observe developments from a careful and cautious perspective. With that being said, here's a quick look at the technicals. The trading volume of Lucid has been around 37 million shares compared to the average volume of 41 million shares. Over the previous 52 weeks period, the price fluctuated between $3.62 and $17.81. The volume of shares traded tells us how many shares are being bought and sold at any given point, and if there's enough liquidity to support a trading strategy. If the float is very thin, it would be easy to push the stock price around, but difficult to exit. And when we compare the current volume against the average volume, there might be the possibility for a trend reversal or breakthrough if the difference is substantial. For instance, if the stock were to break through, the current volume would be much higher than the average volume. The market cap of Lucid is currently around $9.6 billion. As we compare the current price to the historical price fluctuations, the stock is 3% higher than the 1-month low, 16% higher than the 3-month low, and 16% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment about where the stock price is likely going to head next, the implied volatility is 83% compared to a historical volatility of 72%. The put-call volume ratio is currently at around 74%. It is normal for most stocks to also have a higher put option volume than what they deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 86,000 contracts a day versus the 30-day average of 78,000. In terms of open interest, the most recent volume of open interest is 1.7 million contracts compared to the 30-day average of 1.7 million contracts. As the shareholder structure goes, the institutional shareholders currently own 74% of the company, which is very impressive given the circumstances, and also given the scale and the history of the company. The biggest shareholders include Vanguard, BlackRock, and Invesco. Typically, it's always good to see some institutional presence when holding a stock long-term, because it offers a layer of stability and a token of reliability. It means that the market is confident that Lucid will be able to deliver long term, which is a very important factor to consider for those who want to hold in the long run. I personally believe that a minimum threshold should be around 30% for institutional ownership, although, of course, there are many exceptions to this rule, as there will always be great companies mostly owned by retail traders. The current short interest is around 30% of the total float, 54% of which come from the dark pools. Typically, if the short interest is above 15% of the total volume and a significant portion of the shorts come from the dark pools, there are arguments to argue that there is a presence for a short squeeze. And of course, given that the current short interest is around 29%, I would argue that there is indeed an argument that we might see a short squeeze going on, especially if the narrative starts to go in favor of Lucid for whatever reason, whether it's reasonable or. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell-offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, The stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. If your goal is swift returns, Lucid might not be the optimal choice. However, for investors with a long-term perspective seeking a stock for sustained holding, Lucid does have its niche, provided that you adhere to a disciplined approach. The key lies in striking a balance between the short-term gains and the potentials for consistent growth over the medium to long term. I would therefore recommend committing between 0.5 and 1% of your portfolio in Lucid, and to split the allocation in batches of 20% at a time over the next couple of months.